Hello and welcome back to my 10 favorite people. Hope you're doing well. I'm incredibly excited for today's video because now that Bitcoin is back below its range low and it has seen a very clear rejection off of its 20-week moving average, our base case scenario of a normal cycle for Bitcoin is looking more and more likely by the day. For one, we're all well aware of Bitcoin's summer seasonality and the Bitcoin summer chop we've been talking about on this channel for months now. And if you look at this price action, even with all the narratives of government selling, BlackRock buying, Mt. Gox selling, Michael Saylor buying, price has been flat and choppy for the entirety of the summer so far, just like every other summer for Bitcoin outside of those post-halving mania years of 2017 and 2021. And now that we're about to enter September, which as everybody is well aware is the worst month for Bitcoin historically, it's hard to have super optimistic expectations in the short term, and it makes this normal cycle scenario incredibly likely in my opinion. And of course, the second main reason is all of the uncertainty surrounding the election. We know markets absolutely hate uncertainty, and this looks like a very close race as of right now. And we know that in election years, the S&P 500 tends to be very volatile and tends to get more and more volatile as we approach November. And if we're expecting volatility in the S&P 500, and we know that this election is going to remain close, it's hard to be incredibly optimistic on Bitcoin in the short term because we know that it tends to be even more volatile than the S&P 500 is. So if we're expecting volatility in traditional markets, we would expect that to be even more exaggerated for Bitcoin. And finally, my third reason is the price action on the US dollar index and the recent support level that it's bounced off of. We know the US dollar index has a very strong inverse correlation with Bitcoin, and the last two times the US dollar index had a very prolonged drop was when Bitcoin had its 2017 and 2021 mania phases, and that's also when we saw those incredible alt seasons as well. So seeing a decent bounce on the US dollar index here after such an aggressive sell-off over the past weeks is something we were expecting and discussed, and now we would expect it to bounce and then really aggressively roll over into this risk-on region. And by then, perhaps Bitcoin may have found its bottom and may be turning higher, especially once all of that election uncertainty is behind us. So we're really waiting on this bounce in the US dollar index to end and then roll over aggressively, which of course is driven by rate cut expectations from the Fed and the Fed's monetary policy. So I truly believe we're going to need to see the first few rate cuts before the US dollar index can really roll over aggressively and perhaps send Bitcoin into a mania phase and follow that normal cycle scenario that we have laid out. And I know there's still a lot of people out there that share charts like this one and say, look at what happened the past two times the Fed cut rates. It coincided nicely with a market-wide sell-off, and rate cuts only happen when the economy is already broken and markets are about to crash. And I see a lot of people spreading that narrative, but when you zoom out a little bit, you see the rate cuts that we got in 95 were bullish, same thing in 89, same thing again in 84, and I recently came across this chart that I'm surprised more people aren't covering. This chart displays the S&P 500's returns 12 months after the first Fed rate cut. And if you take a look at this chart, it tells a completely different story than what people on Twitter and YouTube would have you believe. With a chart like this one, you can see that 12 months after every single first Fed rate cut from the Fed, outside of course, the dot-com bubble and the great financial crisis, which of course were special cases in my opinion, because the dot-com bubble occurred after one of the biggest stock market bull markets in a very, very long time. And of course, we know what happened with all the internet stocks and the unprofitable companies. And then of course, the great financial crisis was essentially the US housing market collapsing on itself as the Fed's interest rate hikes raised the mortgage costs for a huge majority of Americans who could no longer make their payments. But I don't think this cycle is the exact same. Of course, I'm happy to monitor it, and maybe this time is going to be like 2007 and 2001 and not like 95, 89, 84, 80, 74, 70, 67, 60, 57, 54, or 1929. It's actually funny 1929 is there because we all know what happens after those 12 months and then the US economy enters the Great Depression. So maybe we can even include that one with the negatives, but I think sometimes we underestimate how long 12 months is and how much can happen for Bitcoin and the crypto market in 12 months if traditional markets don't absolutely implode after the first Fed rate cut, like a lot of these charts would have you believe. So I'm very happy to monitor it going forward. I'm just not convinced that rate cuts are bearish and mean that markets have to crash. But of course, open to being wrong, and we will monitor it very closely. But as of right now, I think rate cuts are bullish, and I think the Fed will cut rates in September, because if we look at the mandate on their website of promoting maximum employment and stable prices, they got some very solid data prints this week that things are fine and they can start cutting rates slowly. For example, we had initial jobless claims come in below expectations on Thursday, and this is my preferred proxy for layoffs. And of course, we know layoffs are a leading indicator for the unemployment rate. And if you look at where we are with that 231,000 print, still well below the cycle high set in June 2023, and well below how high they were in 2007, in 2001, and in 1990 before the economy entered recession. It was a lot closer to 350 to 380,000 initial jobless claims per week at that time. So I know a lot of people are concerned about the unemployment rate. I'm monitoring it very closely myself, and I know the Fed is using it as an excuse to start cutting rates right now. And if this trend continues to significantly higher levels, then of course, things will probably get ugly and we will likely have a recession. But I think it's a little bit too early to make that conclusion right now, because there's a lot of things that drive the unemployment rate. And I would much rather watch something that we get updates on a lot more often, like initial jobless claims, which we get every week instead of every month, like the unemployment rate, to try and gauge what's happening with the economy. And that covers the first part of the Fed's mandate of promoting maximum employment. But as for stable prices, we got a very good core PCE print this week. The expectation was 2.7%. It came in at 2.6%. And actually remained flat for the year-over-year number. So still gives the Fed a very clear sign, in my opinion, that they can cut rates in September. And if we look at the Fed's projections for 2024 that we received in, I believe, June of this year, their expectation for the end of year for the unemployment rate was 4.0. We know we're a bit ahead on that right now at 4.3, which of course gives them an excuse to cut rates. And then if we look at their projection for end of year for core PCE inflation, the end of year projection was 2.8, but we're a little bit ahead of schedule at 2.6. But of course, it could always get a bounce in the next few months. So I think the Fed has very, very clear impetus to cut rates. And I think the dollar index has been pricing that in over the past few weeks. And I think that's bullish for Bitcoin in the medium term, as long as the economy doesn't implode. And speaking of the economy not imploding, the Fed's target in real GDP is about 2%. Right now, we're sitting at a forecast of about 2.5 based on the latest data. And if we look at real GDP over the past 2 years worth of quarters, we are close to that 2% number. And we know the only way this is possible is because of the deficits being run by the federal government. There is no way GDP would be positive and this economy wouldn't be in deep recession if it weren't for these deficits, which is why I always mention the other player in the room, the federal government, with their spending. A lot of people focus only on the Fed, but when you're running $1.5 to $1.7 trillion deficits, so you're spending $1.5 trillion more than you bring in taxes, you can use that to stimulate the economy. And you can see that we're running a bigger deficit today in 2024 than we ran in the 2008 recession, than we ran in the dot-com bubble recession, and then we ran in 1990s and 1980s. Of course, because of inflation, these dollar numbers are getting bigger and bigger and bigger to have the same impact. But that is why it is very hard for the economy to enter recession when the federal government is running these deficits. And I'm not saying this is never going to be an issue and we can just print money and have larger and larger deficits forever. I'm just saying this can go on for a long time before something breaks. And a lot of us focus too much on the short term, and we look at a chart like this one and feel like everything is going to break tomorrow. But this is a trend that has been going on for decades and decades and decades now. And when you look at how quickly the national debt has been ballooning recently, it's no surprise the Fed wants any excuse to cut rates as soon as possible, so those interest rates on the debt when they roll it over can be lower and slow down the rate of this debt increase. And I think money supply is going to follow it very closely once the Fed goes back to easing, which of course is bullish for Bitcoin in the medium to long term. And that's why we monitor both the federal government's deficits and the monetary policy of the Federal Reserve so closely. And that's because we've seen a very clear correlation between the US national debt and the S&P 500. As that debt has to get monetized, the dollar gets devalued, the currency gets debased, and that of course is the denominator for our risk assets, and that's why they exponentially go up in price as more and more money gets printed by these central banks. And of course we know the S&P 500 is correlated to Bitcoin, so whatever is good for the S&P 500 in terms of currency debasement is good for Bitcoin as well. And if we look at Bitcoin today, yes, we got rejected by that 20-week moving average. Yes, we're back below our range low, and who knows how low we could go on this pullback. I still think there's a decent likelihood the bottom could be in the short term, but I'm open to lower prices being revisited like I have drawn out here in this normal cycle scenario. If we end up seeing something crazy that catches markets off guard with the election, or September ends up being worse than anticipated, or we end up seeing a stronger rally in the dollar than anticipated. But for now, I do think that perhaps that could have been our low, but I'm still prepared for lower. And I still think Bitcoin is in a nice fair value range where I'm not excited to sell or buy at these prices. I'm just happy to sit on my hands and wait for either a buying opportunity or a take profit opportunity because we see a quick spike in prices. But of course, there is always going to be surprises and volatility along the way. And although it's hard for me to not be bullish in the long term when I look at this chart, and when I look at this one showing that Bitcoin has seen these prolonged consolidations before its mania phases in each and every cycle, you never know what's going to happen. Maybe this time is different, but for now, I think governments are going to continue debasing the currency. And if given the option, they will choose to issue more debt and debase the currency more than allowing the economy to hit a terrible recession that breaks everything, which is why I'm bullish risk assets like the S&P 500 in the long term, and I'm bullish Bitcoin in the long term. And especially now that we have these ETFs and anybody can easily buy Bitcoin in their brokerage. I know a lot of people hate BlackRock and the ETFs now because of how painful the past few months of price action has been. But I think in the long term, they're going to be incredibly beneficial and make it very easy for investors and institutions to get exposure to Bitcoin as governments and central banks debase their currencies more and more over time. So for now, we'll wait and see what happens. As long as Bitcoin is below its range low and below its 20-week moving average, no reason to get overly excited in the short term, and I'm preparing for more downside than upside based on how the chart looks as of right now. But anyway, let me know what you expect. Are you expecting an early breakout before the end of the year, the normal cycle scenario, or the failed cycle scenario? I'm sure more and more people are going to start leading towards the failed cycle scenario as we get lower, and that could perhaps be a good signal of when we're getting close to the bottom. And I would love to get some feedback on this chart here. I know a lot of people just keep spreading the narrative of rate cuts being bearish, but this chart just paints such an interesting picture because 12 months is a very, very long time in markets. And I'm sure a lot of these returns ended up getting destroyed. I mean, 1929 is the best example. It's great the S&P 500 was up 3% after the first rate cut, but of course it entered one of its biggest bear markets in history after that. But for now, all we can do is focus on the next 6 to 12 months. And based on this chart here and the returns the S&P 500 sees the first 12 months after the first rate cut, it's hard for me to be bearish knowing that the Federal Reserve is getting ready to start cutting interest rates while the unemployment rate is very close to its cycle lows, while inflation is getting back close to their target, and while the federal government is running these huge deficits. But anyway, as always, thank you so much for the support on the recent videos. Thank you so much for watching, and I'll talk to you soon.